Good afternoon, everybody, for joining us today on our webinar. It is my pleasure to welcome you to our webinar, The Investor Perspective, Challenges, Opportunities and Risks in the Post-COVID World for SMEs. This is the 7th in a series of strategic webinars we are holding with young Arab leaders. We've been a strategic collaborator with the Pearl Initiative since 2018, and we are very grateful for this collaboration and their ongoing support. For those of you that aren't familiar with the Pearl Initiative is the leading and only independent non-profit organisation founded to promote the business case for the implementation of the highest standards of corporate governance, transparency and accountability across the Gulf region's private sector. Launched in 2010 in cooperation with the United Nations Office of Partnerships, the Pearl Initiative aims to convene businesses, decision makers and future young leaders to take the lead in promoting and adopting greater standards in corporate governance. Pearl Initiative engages with wider business ecosystem in the Gulf region, collaborating with over 30 regional universities and partnering with over 40 companies to collectively drive our mission forward. We work as a think tank and build data by publishing cutting-edge research reports and case studies to inspire business change. The webinar we're holding today is being held as part of our governance in micro, small and medium-sized enterprises, MSMEs. As you know, these are considered the backbone of the regional economy and account for between 80% and 90% of registered companies across the region. However, the annual contribution to regional GDP does remain relatively low. As SMEs compete with each other in a saturated marketplace and strive to be both innovative and fiscally sustainable, they must understand the fact that implementing corporate governance is the key to facilitating their growth and success. The Pearl Initiative understands the necessity of good governance for small business success, and in 2017 we launched our Governance in SME program to help engage small businesses on the importance of corporate governance for positive economic outcomes. Good governance is flexible and can be modified and tailored to fit particular businesses' needs. It is not meant solely for the realm of multinationals and large corporations, as is often perceived. SMEs will find that applying corporate governance policies and practices will help them build a stronger, more resilient and more profitable business. We are pleased to hold this webinar to discuss how investors are viewing the risks for Gulf region SMEs in light of COVID-19, as well as the opportunities that remain for small business success. The threat of the COVID-19 pandemic across the globe has brought investors and SMEs to unprecedented situations in terms of investment opportunities and business approach. As a result, most of the SMEs, particularly those in trade and export, are brought to a virtual standstill. The webinar will discuss the current state of investment sector in the UAE and the Gulf, investments opportunities amidst the pandemic, how SMEs can attract investor appetite, the importance of corporate governance in investing and being invested among SMEs, and the investment outlook and what SMEs should prepare for. As I mentioned earlier, we are holding this webinar in collaboration with Young Arab Leaders. So just to give you an introduction about them, they are a not-for-profit organisation founded during the World Economic Forum in 2004 under the patronage of His Highness Sheikh Mohammed bin Rashid Al Maktoum, Vice President and Prime Minister of the UAE and ruler of Dubai. YAL seeks to leverage the capabilities and expertise of its strong regional network of members in order to catalyse the entrepreneurial and professional development of the next generation of leaders. Its mission and vision are to empower the next generation of leaders in the Arab world by developing a strong network of industry and business leaders to serve as mentors and role models to youth and entrepreneurs across the region. It does so by fostering entrepreneurship and innovation and creating a hub for new business investment opportunities. YAL has a mentors network and an advisors network and is engaged in community initiatives such as entrepreneurship workshop series, a mentorship program and weekend competitions, and has a vast support network. Today's webinar is being presented by Mr. Amin bin Talib. We are pleased to welcome Mr. Amin. He's a YAL member and senior portfolio manager at Camara Corp and will be facilitating our webinar today. Amin is an active member of Young Arab Leaders and joined Camara in 2017 as a senior portfolio manager. Prior to this, he served as a portfolio manager for General Pension and Social Security Authority in Abu Dhabi. And Amin has over 15 years experience of managing equities and fixed income portfolios across economic cycles with a predominant focus on emerging and frontier markets. Amin also has experience setting up an integrated front-to-back asset management process to oversee multi-asset portfolios with large institutions, GP, SSA, among others. This is obviously a webinar and we're holding these in lieu of our ability to hold in-person events across the Gulf region. Obviously, it's a different feel and we are unable to have the interactivity that we have face-to-face interaction. However, we are trying to make these webinars as interactive as possible. So you'll notice that there is a panel on your page to submit questions to Amin. These will be filed straight through to Amin, and Amin will be answering those throughout the webinar, or might save them to the end, depending on the approach he chooses to take. So please do feel free to use the webinar interface to virtually raise your hand and use the Q&A function to ask Amin questions. Handing over to Amin now. Once again, Amin, thank you so much for your time and your insights and committing to doing this for us. Good luck. Thank you.
Thank you. Thanks, Yasmin. Thanks everyone. Thank you for having me. I'd like to just start the webinar with a brief disclaimer. So the first one is Chatham House rules apply to this webinar, just to highlight that all the content and information received during this webinar can be replicated without mentioning the identity or affiliations of the participants in this webinar. My experience involves mainly investing in businesses and not running them day to day. I am also not an epidemiologist or virologist, and of course I could be wrong. The agenda, as highlighted by Yasmin earlier, will try to cover the current state of the investment sector in the COVID-19 world, as well as the investment opportunities that could exist in the middle of this pandemic, how SMEs can attract investor appetite, and also deal with all the investment queries going forward, and as well as the investment outlook and what to prepare for post-COVID. So just to highlight, since COVID-19 has hit the region, all the governments in this part of the world have taken drastic measures to curtail movement and to curtail the pandemic expanding across and reduce the infection rates. So predominantly we focus on the measures of in the UAE, where before Ramadan started, most of the movement has been limited to only emergency movements, and by requirement, this would of course have a significant impact on retail activity. And also to highlight that foreign travel restrictions have been put in place quite early on. That would of course have a significant impact on retail, hospitality, and as well as mass gatherings. So the event and media as well as tourism would have a significant impact. Schools, shops and restaurants have been allowed to reopen gradually since the beginning of Ramadan with a limited capacity, and of course social distancing measures in place. This would have a significant impact going forward, and we'll try to drill deeper into this. The key here is that all of these measures had one single focus, which is basically flattening the curve of infection until we figure out what are the next steps with this virus and what treatments are in place. How big are SMEs in the UAE? I think it's a fairly important question. There are different metrics to measure an SME depending what you're looking at, but the key here is we've used the Central Bank of UAE data and the Ministry of Economy. Given it's pretty much clear what is the importance of tourism and travel to the UAE and to the Dubai economy. So tourism and travel in general generates around 45% of non-oil GDP, according to Dubai statistics. We all know that by now it's been public that the Expo 2020 has been delayed, and the anticipated upside from that and the recovery that will be generated from the Expo has been delayed till next year. And to clarify, according to the data and the numbers that we have, 94% of total companies operating in the UAE are SMEs. These have the 94% is in broad numbers, so counting the number of companies. 73% of these are involved in wholesale and retail trade, And obviously, when you have a big curtailment of movement, as well as limited activity in hotels, restaurants, and shops, and mainly what is generally labeled as HoReCa, which is hotels, restaurants, and cafes, that should also have a significant impact. 16% are in the service sector, and 11% are in manufacturing. 350,000 companies are working on the SME platform for the Ministry of Economy are actually considered as SMEs, and they provide 86% of the private sector total workforce. This shows that if SMEs are not supported in this environment, the employment would be also impacted, since the SME sector provides around 86% of the total private sector jobs. 60% of the UAE contribution into non-oil GDP comes from SMEs. So having that significant contribution and SMEs being curtailed in their activity would cause a significant impact to GDP when we try to see what could potentially be the impact. The largest funding flowing into the SME sector is still coming from the banks. Banks contribute around 11% of the total loans that they contribute are to the corporate sector, and 5.8% are of the total loans given by banks are given to SMEs in the UAE. And these figures are by the end of 2019. What we can take from this is, given all the economic challenges that are being put in place by COVID-19, given the slow and the low exposure by banks to the SME sector, 5.8% would not cause a big systemic risk for that sector in general. But that said, banks are still the largest provider of capital to the SME sector, so making sure they're in good shape and they have enough liquidity is fairly critical. Just to highlight all the measures that have been put in place, there isn't a single government in the GCC that hasn't put a sizable stimulus in place to support the economy, and predominantly directed to SMEs and preserve employment. The Dubai government has announced 1.5 billion, around $409 million of stimulus as of the 12th of March. It had 15 different initiatives. Each initiative is detailed for every sector, and it's widely available across all the official means of communication by the government. One of the key measures, we'll try to focus as much as possible on the measures that are aimed at SMEs, given how important and how big they are within the UAE economy, and mainly with respect to the non-oil economy in the UAE. There has been announcements for roughly around 10% discount on utility bills and waivers on down payments across all free zones for trade licenses and installments, and also flexibility in terms of paying all the licenses for SMEs in general. The UAE has also the UAE Central Bank has incentivized all banks to moderate any potential enforcement action against SMEs. This measure has been extended till September. Free zones have also lowered or suspended fees for renewals, that to facilitate SMEs continuing as a going concern. One program that has been announced by the central bank, which is a very important one, and has been labeled the Targeted Economic Support Scheme. It's a program announced by the UAE Central Bank to make sure that the banks continue providing loans and support to SMEs in the region. And that's a fairly important one because given the economic challenges that are happening, if you add to that a shortage of liquidity or funding, it could spiral the crisis even more. And these are lessons learned from the global financial crisis, when a liquidity issue became a solvency issue, and a solvency issue became an employment issue, and it spiraled into a much larger crisis. So given all of these lessons, the government have put in this program to make sure that liquidity is still widely available for all SMEs. There's also around 100 billion dirhams that have been allocated to credit and capital support to the banks. There is a 50 billion tranche that will be distributed as a 0% interest collateralized loans for banks operating in UAE. These are loans that could be utilized for COVID impacted firms, and they will carry a 0% interest. 50 billion, another 50 billion has been allocated to free up liquidity buffers for banks. So part of the strict, all the UAE banks are very well capitalized, and they've been actually holding excess capital relative to the minimum requirements by the central bank. The central bank has freed up around 50 billion of liquidity there just by reducing part of the capital requirements to make sure that all the banks have enough liquidity and are incentivized to continue lending. As of April 20th, this program has been utilized up to 30%. So already 1/3 has been given out as loans and support. So it's evidence that this program is working, because within one month, actually less than 1 month of its announcement, it's been 30% deployed. There are also talks to have it topped up and increased further to support the economic recovery when coming out of COVID. There's also different measures that have been announced by each emirate. So the Emirate of Abu Dhabi has announced a 3 billion dirhams allocated as investments through Abu Dhabi Investment Office. Also across all federal entities and government entities, a measure that was widely implemented, which is bid bonds and performance guarantees, have been waived for projects up to 50 million. So all projects that SMEs can bid for that are below 50 million don't require any more bid bonds or performance guarantee to stimulate the sector. So all of this package of measures is evidence just to highlight the support that will be provided for SMEs. I think it's important also to ask a question after this, that how big is that program, and is it enough? We've taken a comparison of all programs and stimulus packages adopted globally. It's pretty clear that the largest program announced so far, just by the numbers, is in the US. The US so far has implemented 11% stimulus relative to its GDP to support the economy and to prepare for the recovery. Also, an important data point: if we want to compare the amount of stimulus put in place now compared to what has been done in the global financial crisis, it's pretty much non-comparable. We are at the beginning of the COVID impact, and already we've exceeded all the fiscal easing that has been done during the global financial crisis. In the US, the amounts are actually almost getting close to double the fiscal impact. The only puzzle or the only bad student in the classroom per se is in the euro area, where for some reason the fiscal easing is still lagging behind because governments are still unable to agree on a broad EU scheme that will allow all European countries to have enough support. The average globally for fiscal easing and to support the economies is around 6% relative to 5% in the global financial crisis. In the UAE and how the UAE stacks up, around 6% of the GDP is just the test program alone, excluding all other programs, which means all the programs in place would add up to a much higher figure than the current 6% of GDP. So the test program has been made as equivalent to, in line with kind of the global average, but adding all the other programs, we would exceed the fiscal easing that has been put in place. The key risk here is the execution of that program. It has to be, which is very critical. It has to be done in a very swift manner. We've already seen that the part 30% of the test program has been already deployed. There are already talks to extend that to other sectors. The key additional features that have been added to that are not only linked to dollar value or investments. There are also lower capital requirements for loans to SMEs. So the central bank has issued guidelines allowing lower capitalized SMEs to apply for loans there. There has been also an increase in LTV for loan to values for first-time mortgages by 5%. So what that means is part of the measures that have been made to support indirectly the real estate sector is previously for first-time mortgages, the LTV could not exceed 75%. There is a measure now allowing banks to increase that to 80% and subject to the internal risk measures of every bank. The higher exposure is up to 30%. So before banks were allowed to lend up to 20% of their balance sheet to real estate, this limit has been increased to 30%. So they've technically incentivized all banks in the UAE to lend even more to the real estate sector by increasing the limit exposure. There is also a reduction in merchant discount rate, which is a more relevant measure for SMEs. Which means that basically the average fees charged on online or payments, given that SMEs are now, if their only majority source of business is online, so merchant discount rates have been reduced. And there's also a cap on fees that have been put in place in terms of what fees can be charged for SMEs by banks. So that cap has already been put in place. So all of these measures, just to highlight that there is a serious incentives and there are lessons learned from the previous crisis that are pushing governments to act as quickly and as swiftly as possible to support the economic environment in their respective countries. One ray of hope that is planned is that support is still expected to continue until we have a formal riddance of COVID-19. If to highlight that in Q1 this year, there's an organization called CEPI, which is a central organization that centralizes research for vaccines globally. They're based out of Norway. Within the first quarter of this year, they've gathered north of $30 billion of funding, $30 billion of funding to support vaccine research for COVID-19 globally. It's the highest ever amount spent in research for vaccines in one quarter. According to Milken Institute tracking figures, there's around 197 treatments and treatment subcategories that are being currently researched to treat COVID-19, and also 111 vaccine candidates. Each one of them are in different stages of research and development. There's also a positive news here that while all of that research is taking place, there's also a significant effort to make sure that we have enough production capacity that aims at ramping up production of vaccine doses whenever the vaccine has been vetted. So until that process is finalized and is clear, once we have a clear treatment and a clear or a clear vaccine, the economic challenges are still going to be there, and they will prevail. If we look at the current state of investments and where we are, just tracking the data provided by Google, we use the Google Mobility Report, which is available online, that gathers data from Google Maps and the different apps that Google has. We see that activity for parks and public parks has declined 71%, 61% for retail and recreation. That's basically footfall numbers in Q1 relative to last year. 57% decline in workplaces. The average across the board is roughly around 42% decline in activity. That's in Q1 alone. One key figure here to highlight is the bulk of the lockdown and the curtailment has happened in Q2. Most of the lockdown and curfews and limitations in movements to flatten the curve for COVID have happened mid-March or end of March. So we expect Q2 figures to be, or the second quarter figures to be slightly worse than Q1 before recovering later on. The GCC average is roughly around 31%. And Saudi Arabia is 38%, and in Bahrain, that has the least amount of strict measures, the decline was around 21%. The one thing to highlight is the COVID shock did not come in at the best of times, because Q1 the UAE economy was already slowing down due to a variety of economic factors. One of them is there was a slowdown in global trade because of the trade war between the US and China by late last year. That was already disrupting supply chains, and most of the large corporates were trying to review their supply chain plans by shifting some of the production out of China. This COVID crisis has happened in the midst of all of that, in addition to geopolitical tensions and also a slowdown of trade, resulting in a slowdown of investments. This all brings us to a key thing, that an economic contraction is literally unavoidable this year. The best of estimates, which are looking slightly positive now, is to have non-oil GDP shrinking by roughly around 5% this year. This assumes that all the fiscal measures that have been put in place do work efficiently and timely, in addition to an extension of these measures for the second quarter of this year. If these measures are not extended, then the GDP could shrink more than 5%. This is obviously worse than 2008 and the global financial crisis, which was much slower to happen and to materialize. All of that said, there are no serious concerns over the macro stability on the peg or the peg of UAE dirham or US dollar, as per our view and most of our discussions with all our investment partners. There is also no issue in terms of the UAE being able to fund or finance the deficit of 10% this year, and these are the estimates roughly because of the drop in oil prices as well as the stimulus spending that is taking place. There are no issues in financing that. Abu Dhabi has already tapped the market. They raised $7 billion in April, despite the drop in oil prices at very attractive rates. And that issue was more than 3 times oversubscribed. So they got a demand of north of 20 billion when the target was to raise 7 billion. So there's no issue there in terms of the ability to fund all of these programs without tapping into the sovereign wealth fund reserves and the government ample resources. One key issue here is that fiscal deficit is dependent also on oil prices. The budget for the beginning of this year has been set at roughly a break-even of $86. The current price is $29, and this is just the latest price, but the average price for the last 2 months has been much lower because oil prices were at a lower level for most of that period. So just to highlight, this is the broad macro environment in which we're operating in. And the key indicator for the level of distress that is happening is when we track information from all the banks. Lucky enough, Emirates and BD, which is the largest bank in Dubai and one of the largest operators within the retail and SME sectors, has announced their figures. The figures are public and it's a publicly traded company. One key metric that we follow just to monitor the level of distress in the SME market is we look at increase in provisions and exposures. The bank, and as per IFRS requirements, they categorize the loan exposures in 3 stages. So stage 3 is for all loans that are in excess of 90 days, where the customer has had some difficulty in paying and is under monitoring for the last 90 days and have not gotten back to a normal pace of repayment of the loans. So stage 1 loans have not skyrocketed or increased significantly, but the bulk of the increase was in stage 2, which means that banks were monitoring a lot of loans already that were in stage 1 and are expecting them to go to stage 2 right away, which means that for the next 2 months, the majority of small corporates or SMEs will struggle in terms of servicing their loans for at least another 2 months. They have, on the other side, increased provisions significantly, so which means banks do take a provision as mandated by central bank whenever all the loans are doubtful. The amount of total provisions have increased by 52%, so roughly the total amount of provision taken so far is around 2.5 billion dirhams for Emirates and BD alone, which is a very significant amount compared to last year. Also, the bulk of that provisioning is focused on stage 2 loans, which means loans that have had already skips for 1 month and are getting and have skipped for the 2nd month in terms of payments. This figure has been announced by the bank that it could significantly increase for the rest of the year, just highlighting the economic distress that is happening within SMEs in the country. In the middle of all of that, we still see investment opportunities in the UAE that are happening, especially within the SME and startup space. There are significant opportunities that are materializing. But before we get there, we just want to go over what has changed in terms of new trends for customers. So how are customers looking at and what are they looking at now? So we utilized a couple of surveys from leading experience research firms and brand experience research firms. So the first key metric is most of the store setup and retail is going to be based on a look and not touching context. So checking products to pay for them is not going to be allowed. We're going to be more into a world of contactless, where cash as a mean of transaction is losing market share, and preference to use cards and other means of payment is going to be more abundant and will be the norm. Protecting personal space is going to be even more critical. So social distancing in any store is not going to be an option. Shopping local is more important. So basically, for any mall or retail or business that's going to open, figuring out the close demand of your customers nearby is going to be fairly important. So location is going to be an issue. And the preference highlighted by most customers is shopping locally compared to going far distances or global. That's also assuming that lockdowns get released pretty quickly and people are not subject to curfews going forward. They would still favor or prefer to shop local. The discretionary spending is dropping, and that's a trend globally, not only in UAE. So priority will always be for necessities, groceries, households, essentials, and of course the discretionary spending can wait. So anything including the next model of a smartphone or an upgrade consumption is delayed for now. Everything is going virtual, including this new mean of communication. So from meetings to learning to even exercising and sports and gyms have started offering online exercises, and online gain and online market share is exceedingly rampant compared to offline. Any retail right now with no online presence is bound to disappear. So the whole focus in terms of customers and customer comfort with online shopping and e-commerce is even there, including B2B and B2C. So that's a trend that has been there for quite some time. This virus has helped accelerate that trend even more. Loyal brands will be even more important. So the focus will be on safety first, cleanliness in stores, sanitizing. The green economy will take a backseat as humanity is more focused on survival, and the customer will consider cleanliness in stores and sanitizing as more important. Across the whole retail chain, there's also an abundance of reuse of plastic bags. So people have stopped basically recycling there just for obvious reasons to avoid the spread of the virus. There are also globally driven decisions that are taking more and more a front seat. So everyone is more conscious where their goods are sourced from, produced. Transparency also on the global supply chain. So even more corporates now are focused on making their supply chain even more efficient with less buffer and with actually more buffer at this point in time. So just in time and lean supply chains are bound to disappear. The focus on optimizing costs is not anymore the priority. Having transparency on the full supply chain is even more important. And also deadlines and delay in deliveries is even more important, as well as all the scrutiny that will happen by customers in the current environment. So these are the key trends that the new customer post-COVID are, and the key changes that we believe are happening. The other part is across the whole investment opportunities, there are key themes that are happening. So as well as three main investment conclusions that we believe are going to be there with us for quite some time. We're obviously entering a new economic cycle, which is completely different than the one that we've had before, where we still believe that valuations are going to be expanding. So we were in an environment where it became pretty normal for a startup or a large startup are priced at exorbitant figures. We believe we will come back to that environment, but that's driven by central banks and mainly the leading one, which is the Fed, injecting so much liquidity so quickly and dropping interest rates. There will also be a high level of debt by the government. So unfortunately, that much liquidity and that much interest rate is necessary to finance the fiscal deficit happening globally. So levels of debt are going to significantly increase by large corporates and by governments. From a long-term macro perspective, this is a risk, but short-term, it's not a risk. This will put us in a very low inflation environment. We will continue to move into the digital world, and the digital revolution will even more amplify. We will be in even more diversified supply chains. So any company, for example, your next Apple is going to eventually cost more. Your next smartphone or laptop is going to cost more, just because each of these corporates is going to start planning even more capacity or leeway in their supply chain, and that will have a cost effect that they'll have to monetize. The good thing also is their ability to pass on these costs is going to be much lower, because we're coming into an environment where which is pretty weak, where bargaining power and consumption power is much lower because of the challenges on employment and coming out of a recession that will take time for us to recover. There will be more consolidation and M&A. We've had our fair share of that in the UAE, with banks consolidating massively. There will also be a greater focus on the social contract, on ESG and corporate governance. The social contract is every single company will be scrutinized how they treat their employees and their customers and stakeholders post COVID. All of that will result in three main key things when looking at investments, at least from a global perspective, and this has been shared by several investment funds that we speak to. Growth is going to be even more scarce. It's going to be even more challenging to find large corporates or small ones or even SMEs that can generate growth as significantly as before. Income will remain scarce, so high dividend payments because of the low interest rates environment will be increased in terms of valuation. So it's going to be even more challenging to have high yielding assets, from real estate to stocks to ability of companies to pay even more dividends. Debt levels will be higher, and of course, in an environment like that, companies that can grow faster with a cleaner balance sheet would warrant even more interest. The key thing is we will take what that means across a variety of sectors. So across the board, there are sectors that we believe are key beneficiaries in this part of the world and in our region. And the key theme here is the on-demand economy versus old economy. These are sectors that on-demand economy is obviously going to gain even more market share, and that applies to any sector you can think of. The stay-home economy, which has just appeared pretty quickly, and we've already seen globally a key trend of a lot of corporates and new startups trying to take advantage of that. The experience economy will still be there, with a more focus on safety. If we drill deeper on each one, it's predominantly for healthcare. I think the regional healthcare industry is due for a revolution and for bridging a gap. It's surprisingly challenging and strange for us. It should not be more difficult to order a pizza than to see a doctor or have a prescription. It should be on demand and smooth, and there are a lot of companies globally that are considering an entrance to the region. In the retail side, retail will be challenged, and the physical retail will be even more challenged. But it's due also for a revolution. Last mile delivery will be key to support the whole growth in e-commerce. In addition to subscription e-commerce and specialty retail, there are concepts that are happening globally that are gaining and getting market share compared to the whole supermarket concept, where you go to an Amazon and order everything you can think of, and the whole retail concept is getting the second stage of that, and that we expect to see in the region is more subscription e-commerce, where, for example, grooming for men or female hygiene, we pretty much know that we shave X amount per week, etc. So you'll have that subscribed, and then your e-commerce provider or your e-commerce platform will supply whatever you need, whenever you need it, on a monthly or timely basis. The key here also, that one of the industries that we believe is due for a revolution and will quickly close the technology gap is marketing and events. Events and large gatherings are going to be banned and are going to be considered risky for quite some time, at least by customers, even if they're allowed all of a sudden. So the use and the organization of events is going to be even more critical and challenged. Marketing and event management companies are going to have to figure out a way to do that. And I think we've seen leads from what's happening globally, where events are more online, but structured on data derived from social media and research platforms. And in the presentation, there are examples of companies that leverage that. So StubHub and Viagogo are two large companies that have merged right before the COVID-19 crisis, and have also announced that they're going to migrate all of their event platform to a data-driven event organization. So any event that will be on their platform will be sold predominantly online and will be designed using data derived from social media. So that could lead me to my next point, which is that social media are becoming more and more as data supermarkets. So for marketing research, companies will have to adapt there, and we already see a plethora of companies coming to tap into that, and we believe that trend is going to expand to the region pretty soon, where companies are going to aim at implementing an active social listening strategy, whereby they gather data from social media, which are acting as data supermarkets. So each company to know exactly how their customer feel, what is the typology of their customers, what do they like, what do they don't like, of course with the full respect of privacy, etc. But most of that industry is going to be focused on data and data management, and will be data driven. Marketing research and marketing companies and event management companies will have to adopt that to adapt to the new world. Real estate also as an industry will significantly change. All of a sudden we realize that we can work from home. It's not impossible, and we can work efficiently from home. Coming back to the office, being present and physically present in an office is going to become less and less of a necessity. There are already companies that have announced that they are considering authorizing their employees to work from home indefinitely. This trend is going to continue. It will have an impact on real estate, obviously. So being central and downtown and closer to your office is not anymore a necessity. In certain reports that we've seen are that even some demand on real estate as far away from the city as possible could be expected. That basically could have an issue across real estate pricing going forward. It's also an industry that is due for a disruption. There are already models of owning real estate fractionally, which means that we could consider a plan where a person could use real estate in line with what Airbnb is doing, but at the same time, on top of that, adding a layer of owning real estate fractionally, where a group of investors can easily own one single unit or one single property. The same applies for banking, investments, where a lot of industry trends there are based on security issues. KYC and heavy processes are now easily facilitated with technology. And education is one that has been noticing a slow revolution, but now e-learning is there, and it's not going to disappear anytime soon. Streaming is one key sector where the region is lagging behind. We have yet to see providers of content for streaming platforms globally that are from the region, that know the region very well, that know the taste. I mean, there are efforts to other platforms that have started mainly sponsored by old media, but that's something that will eventually kickstart in the region, and there are already talks by some telecom companies to start their own streaming platforms, and then the second step would be the content part. These are all sectors that we believe will notice significant trend and that are worth considering, and where the region is going to close a technology gap sooner or later. Now the next phase is basically what SMEs should do to attract investor appetite in this environment. The interesting thing is, of course, investors in that environment would be even more cautious than pre-COVID environment, for obvious reasons, where liquidity is going to be challenged and valuations are challenged, at least in the short term. But that does not mean that the whole investment world is shut. The other most important thing is, before approaching investors, it's very important to map them, to know all types of investors by size, type, and geography, as well as sector preference and investment process. There are databases like Preqin or Burgess or Cambridge Associates that provide a decent amount of support, and these are databases that are widely available, and they could offer that type of intelligence for SMEs or platforms seeking investments and how to approach investors. The other most important part is you need to choose your investor carefully. Not all dollars are equal, as they say. Some investors would always choose to invest in companies in which they will provide value add, rather than passive or active investors, or supportive investors to SMEs and corporates are even more interesting compared to a passive investor that will just provide a simple check. That discussion has to be there, and that's where the mapping by size, by geography, and by investment process is also very critical. One thing to note is that fundraising is generally a process. It will become even more of a process now than before. There's a variety of fundraising structures that could be implemented, from safe notes to convertible to a simple equity injection. So choosing which one, and the one that fits the most the SME before engaging with the investor, is very important. There is enough instability and uncertainty in the investment world. If a corporate comes in without, or an SME or comes in seeking investment without knowing exactly what they need, it could be badly perceived or frowned upon from investors. You have to be very specific, meaning you should know exactly how much you want to raise, the size of the funding required, the timing required, and the format. And the critical thing is, right now, what we're noticing, we obviously see conversations that don't pan out well, but most of the ones that do pan out quite well are ones that start with significant flexibility from the SME or the entrepreneur, and where discussion is more open, though the entrepreneur would know exactly what they want and what they need in an optimal environment. The critical thing also is to be ready to undergo scrutiny, to be checked and cross-checked in terms of business plan. Be ready also to change the terms of the funding significantly. It's never the case that the initial terms in a fundraise are the same ones at the end. The other most important one is to also prepare for a contingency plan, which means that if you're planning to fundraise in 3 months, it could take much longer. It could take way more longer than planned. So having a contingency plan in place is critical. There are cases where it takes a shorter period of time, and we've seen events where that happened. Also, preparing for a plan A and B and C is also important. So, for example, we've seen situations where startups or in the private equity space, or SMEs trying to raise funds from investors, and wanting the full amount to be invested right away without actually a clear explanation on why that would be required. That's why being ready to stagger in a staggered milestone approach is even more going to be the norm than before. So, and what I mean by that is subject to the company or the management of the company achieving certain milestones, they will be entitled to draw an additional amount of capital and funding. The most important part is to be fully prepared also before approaching investors. So having and not hesitating to utilize the full scale of technology. Data rooms now are widely available. So Dropbox, from Dropbox to Box to even Google to each one of these provides a data room solution. So using it to prepare every single documentation that could be asked by investors is very important, from a clear business plan to all the data backing to conservative assumptions being utilized, and putting all of that in an organized data room is becoming the norm, and it's going to become even more the norm going forward. The most important additional points are related to providing a clear structure of governance. So having a clear organizational structure, a board in place, an advisory board in place is also important. One thing that will become less, and we've seen that happening more, you don't want to be taking a key man risk in an SME format. So the focus is more on teams and a balanced organizational and governance structure. And in addition to the early end points of providing as much detail in terms of business plan as possible. Aligning the interest fully, and it's a very, very tricky exercise with those of the investors is very important. One cannot be seen to be making a lot of money with risk in comparison to the investors down the line. So that structure of aligning the interest, be it in terms of expensing or salaries or returns later on, is also important. And by the way, it goes both ways going forward. So entrepreneurs and investors have to make sure that their interests are fully aligned. Any misalignment there ends up in most of the times in a bad experience. Majority of SMEs do fail when they want to raise capital, but the reason of failure is more or less the same. It's either financial planning that has been not done in place, working capital, or projected runway in terms of funding was not enough, or lack of oversight of governance. The key risk is, the outcome from all of these is the financial loss, but the financial loss sometimes, if it's planned for and announced and discussed openly with investors, is actually acceptable. We are in companies that we see that they will continue to lose money, and we stepped in this environment and supported them also, as long as it's part of a clear plan and there are many examples of companies that have lost money for years and became successful later on. So having that structure and that plan in place is very important. The critical thing is not to be overly aggressive and announce profitability too early and not achieve it, and that could derail the whole funding plan and then eventually cause failure. The last part is to differentiate between two things. I think there is an exercise that has to be done by every investor or every SME before approaching a fundraise. Tracking investor allocations is very important. I'll try just to summarize that very briefly. There are multiple sources there from Prequin to Cambridge Associates to other data providers that will give you a clear state of the market in terms of where are family offices trying to allocate, where are private equity And just to highlight, there are important figures to track, which are the dry powder, which is basically the amount of cash available by private equity funds and venture capital, as well as funding platforms in this in the UAE, as well as the same pattern in the GCC. So and that will automatically allow you to look at the different structures of how to raise capital. There is one source of funding that was not that popular pre-COVID that we believe is going to become even more popular. We could see a trend of M&A and consolidation. I mean, it's not a word that is only applicable to large corporates. There are also small startups and small companies that have just started that are and should be willing to consider consolidation and M&A. And we have participated in small fundings that plan to do that. That overall idea is this is another source of capital that should be considered when planning for funding. What we've seen is that typically SMEs or entrepreneurs do not consider that as an option. Going forward, I think it's a critical one. Just to highlight here some of the data that is widely available. There is a tracking of the number of investors that volunteer and provide their intel to these platforms and are easily reachable. So one key message here is the allocation that investors or diversified portfolios are willing to do to alternatives are increasing, which is a good thing for SMEs and for startups. So private equity and venture capital and private debt are considered generally alternatives. The average holding there has been around 3% of portfolios, and that data is provided by Preqin. The plan is to increase that to around 6%. So there is more of private capital willing to get involved into the alternative space. The amount of dry powder has also significantly increased to 7 billion. The bulk of investors in the Middle East are mainly investment companies. Anywhere in the world, that may not be the case because it's inefficient to set up a company that just does investments somewhere else. But because of the positive taxation environment in this part of the world, investment companies which act as a proxy for family offices in reality. One key part here about the importance of corporate governance for SMEs and why it is important. It typically facilitates due diligence and also fundraising. There is also a technicality here that is perceived by SMEs that they or startups. They believe that boards or executive committees or subcommittees within a company are the property of large corporates or organized. This is not the case. Small SMEs have converged to this type of governance very early in the cycle, and it's been a positive contributor to the success. There isn't all the large companies now that have started over the last 7 or 8 years, from Facebook to Google to even local examples from Kareem to Okadoc, or that were able to raise funding, have organized themselves very early in the cycle and have utilized a fully transparent governance structure with using independent board, using advisory boards. An advisory board is an important tool because in reality it's free advice rather than hiring an expensive consultant. So that's an important point. It also helps in a fundraising exercise to avoid inherent biases, which are basically buyers of a product are always optimistic and have unrealistic assumptions, and also sellers are typically either want to high price because they believe that their product or their company is too good to be sold at any valuation. The critical thing also is once you have the governance structure in place and cross-checking and a balanced decision making, it's very it's very easy to avoid these biases. Incentive misalignment. So it's another area where the incentive scheme, if they are vetted by a third party and it's not the same entrepreneur or the key man that takes all the decisions in a company, you could end up in a situation where these are not taken into consideration. Of course, a board and executive committees in place would once they vet the numbers, it's even more challenging to have inaccurate financial information being reported or non-proper accounting or anything as such. It also helps in negotiation in the key man risk or entrepreneurs, but from experience have the tendency to badly negotiate a transaction. And also having one committee or a group of people looking at the risk is better than one pair of eyes. Just to highlight basically what companies should prepare for going forward, and that's the last part of my presentation, is basically I've tried to categorize businesses into either B2B, so companies that focus on servicing businesses, or B2C, or companies that focus on both. So as a summary, managing the balance sheet is a critical element. So focusing on having ample liquidity in place and avoiding the trap. If SMEs were coming into the COVID crisis with just 1 month of working capital, it's going to be a very dire situation for them at the current point in time. So making sure that there is always a buffer there is fairly important. You should also, if you're an SME focusing on servicing other businesses, you should be careful of businesses getting out of the COVID crisis and aiming at reducing spending, and assuming that they will continue to spend the same way pre-COVID should not be the normal assumption. Try to raise funding, debt or equity when you less need it, because when you actually need it, it's all of a sudden becomes more expensive. Always do your capital budgeting with a buffer, and digitalize, transform to online platforms as much as possible. Otherwise, you're bound to, if there is a second wave of COVID or any other virus or crisis or health crisis, you're going to be exposed to the same issues. Working capital management is key. How you manage your payment terms with clients, with suppliers is very, very important. And capital preservation is going to be key in this period of crisis. Sacrificing margin to generate cash or generate growth is actually preferable now in an environment where we're going to be in an economically challenged environment for some time. If you're a B2C company, being aware of the trends and the consumer change and the consumer behavior change that we discussed earlier is fairly important. Having an online presence is even more important now. Margin erosion is also going to be there, so don't expect to make the same margins for some time if you want to grow in the current environment. Managing the supply chain is even more important if you're becoming an online business, and making sure that you have the right setup from a supply chain perspective and the right delivery on time. Sourcing locally is going to be the trend, and consistently will become the key rather than sourcing the cheapest product. If you're a hybrid, i.e. a B2B and a B2C at the same time, of course, all of the above applies. In addition to balance sheet becoming even more critical, because if you're dealing with a business and they want to tap you for credit terms or longer payment cycles as well as a customer, then that's even more pressure for the balance sheet. Having a clearer online presence is important, because you cannot have, or you cannot deal with both entities online the same way. I think that pretty much concludes my webinar, and I'm happy to tackle any questions. So I will try to answer as much as possible without I'll try to avoid ignoring any, and try to tackle as much as possible in the interest of time. So one of the questions that I have is, will this be allocated? Will the test program be allocated to media-based companies and service-based companies? Yes, I think there is a clear distinction between all of these. As long as you have an existing banking relationship, it's worth considering that. For example, most of the companies that we've invested in, we had an active discussion with them to approach all the banks and to go ahead and to seek as much clarity on the test program announced by the central bank and to tap into that. And if you see that program has been availed pretty quickly, it's already been used at 30%. So there is no limitation on services or media-based companies. The relationship is how good is the relationship with the bank to avail all of that support. There is one question that says, okay, how startups which are into social marketing, sustainable products, are facing the dilemma from economic drive startup where customer views the price and does not want to pay sustainable product. I think just to deal with that in two steps, I think that there is a change in customer behavior that is expected. The more focus on safety is there. And I think transparency in pricing is also important. And how you communicate to the customer is important. The key here is typically customers don't want to pay more if they don't have a clear transparency on pricing or clear visibility. So the pricing strategy has to be involved into justify why you're more expensive. If, for example, you run your competitive analysis, and the typical case here is between other Chinese manufacturers of smartphones and Apple. Everyone knows why Apple is more expensive compared to other manufacturers, and they provide enough visibility as to why they have a more expensive product, and they don't mind. Some customers don't mind actually paying the premium, and others have another preference. Approaching that with the diversity of pricing options is always important, and having for an SME and disclosing why you're pricing your product that way is going to be even more critical. And the loyalty and the transparency is going to be even more important. We've had discussions where, for example, in a typical case, I was in a situation with a company where we had a similar issue where another supplier of the same product decided to price the software at a fraction of the cost that we had. We had talks with customers as to how we can match their price, and what would that mean in terms of quality, costs, and cuts and lack of service. Some customers opted for the reduced service and the reduced pricing, and others opted not to do that. The other questions, I think some of them have to do with other diseases not killing or not impacting our lives as much as COVID. To be honest, I don't have the answer to that. My simple interpretation is we are where we are today because COVID is dangerous and it's impacting people. And rather than thinking why are we here, etc., it's just a situation that I believe we should deal with and move on. There are large and global efforts that are being made to cope with the situation. Of course, that's all of the investments. We just wish that we put the same effort equally for other diseases and other issues and deal with them the same way. The problem is I don't think we can afford to deal with them the same way because we cannot afford to spend $30 billion in research for vaccines for every disease on a yearly basis. We could, the global economy cannot afford that, and we cannot afford to be in lockdowns whenever an issue like this happens longer than where we've been. So I think governments also will hit their limits, and I think the way we deal with healthcare is going to be even more important going forward. I think that's pretty much it in terms of questions, unless I've missed any other thing. Thank you very much for your participation, and I hope you enjoyed the webinar.